Thank you very much. Dr. Keyes, let me start with you. I want to show this graph from our report, which compares the non-renewal rates that we found across the country over time and breaks them out into the various climate risk quintiles. It appears that depending on your quintile, lowest climate risk, lowest non-renewal rate increase, higher climate risk, higher climate rate renewal increase, and all the way up to in the top quintile where the non-renewal rate really is growing explosively. That is the information that we gathered. How does that correlate with what your work shows?
Well, thank you, Senator. I think that this is the most striking chart in the report and the data that's been shared with me, very clearly seeing an extremely sharp and differential increase in those riskiest, most exposed counties. I think one of the other striking takeaways is how much variation there is within states. And so even in a state that might have the same regulatory regime across the entire state, you see very different patterns, say, along the Carolina coast.
So before you go to that,
yes,
let me just go back. More climate risk, higher non-renewal rates.
Dramatically.
Is that correlation consistent with what you see through your own research?
Yes, much higher non-renewal rates here, much higher premiums in the premiums.
Now let's flip to your second
analysis.
point, which coincidentally I want to illustrate with a second graph. So we have graphs in the report that show the state level of non-renewals. And unsurprisingly, Florida and Southern California, where their wildfires are very significant. But once you actually drill down to the county levels, as you were beginning to describe, I believe, which is why I wanted to put this graphic up, then you begin to see things break out that are a little unexpected. I mean, obviously, every county in Florida is in big trouble with very high non-renewal rates. But if you look up, for instance, at New York doesn't even appear in the top 30 states, I don't believe. It's not particularly troubled from a non-renewal point of view. But when you drill down to the counties and you look at, say, a coastal county on Long Island, suddenly you see the same explosive growth in non-renewal rates and the same high non-renewal rates that you see. Could you comment a little bit on what drilling down to the county level shows us about how this non-renewal crisis is developing?
Yes, thank you. I think it reinforces this takeaway along the lines of the last figure you showed, which is that there is differential risk and that especially exposed counties are seeing much sharper changes in the availability of insurance. We're also seeing that that's related to the price of insurance as well. So certainly related and very much concentrated in the highest climate risk areas, especially along the coasts, but also in areas, as you mentioned at the outset, like in Oklahoma and parts of New Mexico.
Which would suggest that insurers are making highly localized risk-based decisions when they're deciding to non-renew and not just writing off all of New York or something like that. They're really drilling down and looking closely at individual properties and property owners. Mr. Shigalian, is that what you're seeing in Rhode Island? Do you think the insurers are can differentiate between coastal properties, for instance, and others?
So what I see in Rhode Island...
If your microphone's not on, please turn it on.
It's on, I guess.
Okay, good.
Yeah, so what I see in Rhode Island is most insurers have like a mileage. You know, if you're within 3 miles of the coast, then you've got problems. In Rhode Island, as you know, if you're in Forster, Rhode Island, or you're in 10 miles, 12 miles inland, it's not that much of a problem. So it's predominantly the coastal communities.
And I understood Dr. Hartwig's testimony to be basically insurance is sound, insurance is stable, nothing to see here, folks, not a problem. How does that correlate with your experience with your clients in Rhode Island? Are they seeing that everything's fine and there are no problems?
So there's no problem with the insurance companies. The problem is with the consumers that are being forced into risk pools, being forced into the surplus lines markets, being forced to pay more money for the insurance, and having less availability of optional coverages.
My time's up.